Welcome to ETF Junction channel. You must be, assessing everything's performance. And when we talk about an ETF, it also has to track a performance. Has it really delivered better or is it behind the curve? Now, there's something called tracking error. This is a particular terms which is synonymous with assessing the performance of an ETF. Let's understand first of all what is it, and this is just to understand that as the word tracking error, it tracks the error which is inherent in an ETF. How better has it performed or how worse it has performed. Now when you look at the definition is that this tracking error is a difference between the return from an ETF and inherent index. So for example, if we take NSE as an index and there is an ETF called SBI Nifty 50. So if the return between the two is more, or difference in the return between the two is more, the tracking error is said to be more. Ideally, it should be almost exactly equal. But in reality, it can never be equal because indexes doesn't have cost. Now let's look at what are the reasons for a tracking error to come. First and most important, index doesn't have a management cost, whereas an ETF has a management cost. So obviously, whatever may be the cost, for example, a very good ETF in India has a tracking error of 0.03%. That is really a much better to have, almost close to the indices which they are tracking. So the one reason is that management cost. Let's look at the second. ETFs are not always fully invested. The fund manager maintains a cash component to meet the redemption or maybe for some corporate actions. That is where the gap will come. Third, when you go and buy inherent stocks in an ETF, it could be illiquid. So you have to pay extra price both for buying and selling. That can drag the performance. Third, there could be announcement of dividend, and dividend in your account or the cash coming in your account could be little late. And when that comes in, then only you can depute that to the ETF. And last and most important is that whenever the entire component of indices are changed, for example in India, the indexes are changed, the component of indexes are changed twice a year. So whenever that change happens, you have to sell the one which has been moved out and buy the one which has been taken to the index. That may have a lag effect, which is not reflected in indices because it happened very fast, and here it can come slightly later. These are the reasons why the tracking error comes in a portfolio. Now let's look at what is the implication of this tracking error on the fund or on ETF. So the first and foremost is that the lesser the tracking error, the better is the overall return from an ETF. That's one. Second, on an average, it should not ever exceed more than 2%. And we have seen that there are a lot of ETFs which are being managed much better than 2%. Third, can it be completely eliminated? It is completely up to the fund manager how he has managed it, so that there is almost no error. But there is no guarantee which is given by any of the fund managers. It all depends on the market conditions and also the factors which are just elucidated that how can it be reduced further. Hope you got a fair bit of clarity on the tracking error. We would continue to address more such technical terms related to ETF investing in our future videos. Please feel free to like, share and subscribe ETF Junction channel for more such videos.